The foundation of the modern market is under historic strain, showing signs of a structural instability that precedes a total systemic collapse. This fragility is why Robert Kiyosaki has issued a specific warning to global investors, signaling a deadline of 2026 for what he calls the largest market crash in history. The risk is a repeat of previous cycles, where average households see their entire net worth neutralized as traditional markets contract. Most investors are currently parked in paper assets, stocks, mutual funds, and bank deposits, operating under the assumption that these vehicles are secure. Relying on these instruments creates a blind spot. When the system faces a total shock, these paper claims lose value first, leaving the everyday investor fully exposed. The mechanism behind this vulnerability is the nature of fiat currency. Because governments can print currency on demand, the supply is essentially infinite. As more currency enters the system, the purchasing power of every existing unit drops. This creates a persistent drain on the savings of those who hold their wealth in cash. In his foundational work, Kiyosaki argues that the only way to halt this loss is to recognize the difference between fake money and assets with intrinsic physical value. Survival requires moving capital out of the path of infinite printing and into resources that are strictly finite before the 2026 window closes. Historically, large-scale capital moves into physical havens long before the general public realizes a crash is imminent. Gold remains the primary shield during economic crises. It is a time-tested asset that maintains value when trust in government-issued paper fails. This chart tracks gold's trajectory from 2016, showing a steady climb that Kiyosaki expects to reach the 1.6 lakh mark per 10 grams as the 2026 crash nears. Silver provides a similar hedge, but with an added layer of utility. It functions as a store of value while also being a critical component in global industrial manufacturing. Because of this industrial demand, silver is more volatile than gold. This means higher risk, but it also creates opportunities for higher returns when the market swings. These metals form the base of a defensive strategy because their supply cannot be expanded by a central bank's policy. The next pillar focuses on energy, specifically crude oil, which powers the global infrastructure and determines the cost of transport. Global supply is dictated by geopolitical tensions. When major shipping routes are threatened, the cost of energy responds immediately. The impact is concentrated. When just 20% of global supply passes through a single bottleneck, any regional conflict can cause an immediate spike in prices. This logic also applies to food. Agricultural land is a finite resource that remains in demand regardless of how the financial markets are performing. We are facing a reality where an increasing global population must be supported by a strictly limited amount of arable land. Because energy and food are essential for human survival, these assets are largely immune to the inflationary pressures that devalue paper currency. The final tier of the strategy moves away from physical resources to the digital application of absolute scarcity. Bitcoin is built on a mathematical limit. Its value is derived from the fact that its supply cannot be altered by any central authority. While fiat supply expands indefinitely, there is a hard cap of 21 million Bitcoin, making it a digital antidote to inflation. This fixed supply has translated into a steep price increase over the last decade, moving from thousands of rupees to 75 lakh. Ethereum serves as a secondary digital asset, showing high growth potential through its utility in blockchain technology, as seen in its historic move from $10 toward the $5,000 mark. Despite their volatility, these digital assets provide a technological alternative to a banking system that relies on constant currency expansion. Translating these macroeconomic shifts into a personal strategy requires looking at what is actually accessible to the individual investor. For the average retail investor, owning an oil well or 1,000 acres of farmland is not a practical option. To build a crash-resistant portfolio, focus shifts to accessible inflation-beating assets. A targeted 10 to 15% allocation into sovereign gold bonds or silver ETFs provides precious metal benefits without storage burdens. The remainder balances across real estate and diversified funds. This structure provides a way for individual investors to mimic the defensive posture of the wealthy using accessible market instruments. Surviving the 2026 window requires a change in perspective. Security is no longer found in a rising bank balance, but in the ownership of finite resources. Historically, market contractions act as a mechanism of transfer, moving capital from those holding paper claims to those who own the underlying reality. While the 2026 crash will erode paper-based savings, those positioned in these 6 pillars will hold the assets the market still values.